Ever had that amazing feeling of giving a truly significant gift? Maybe helping a loved one with a down payment or covering their college tuition. It feels great, right?
Absolutely. It's a powerful act.
But what if I told you that generosity, that really big gift, might come with, well, tax paperwork?
Ah, yes.
Yeah.
The less fun part.
Exactly. So today we're doing a deep dive into Form 709. That's the U.S. gift, and generation skipping transfer tax return. Now, this isn't your everyday 1040, but for certain, significant financial transfers, it's absolutely essential.
Critically important, in fact.
Our mission today, we want to unpack this form, really demystify its purpose, and most importantly, highlight the honestly incredible tax-saving opportunities that are built right into the rules.
Mm-hmm. There are quite a few if you know where to look.
Think of this as your shortcut to understanding smart, tax-efficient giving. We know tax forms can feel like trying to read, I don't know, ancient hieroglyphs sometimes.
They can be dense for sure.
So we're here to be your guides. We'll point out the most important nuggets of knowledge, those satisfying aha moments that can genuinely reshape your financial planning.
Let's do it.
Okay, so let's start right at the beginning. Before we even think about filling lines out, let's tackle the fundamental question. What is Form 709 actually for, and why might you, our listener, even need to file it?
Right. So at its core, it has a dual purpose. First, it's the way you report transfers that might be subject to the federal gift tax.
Yeah.
And it also covers certain generation skipping transfer taxes, or GST taxes.
GST. Okay.
Second, it's how you figure out if any tax is actually due on those transfers. And critically, it's also the mechanism you use to allocate your lifetime GST exemption. That's a really powerful tool for multi-generational wealth planning.
Got it. So reporting, calculating tax, and managing that GST exemption.
Precisely.
Now, it's important to clarify the scope here, right? This isn't for, like, every birthday present you give.
Oh, definitely not. This is specifically for gifts of property, real property,
Right.
like land or a house, personal property like a car or artwork, or even intangible property like stocks, bonds, or intellectual property rights.
Tangible or intangible, okay.
And these gifts can be made directly, person to person, or indirectly, maybe through a trust. The tax can even apply to things that look like sales or exchanges if they aren't really ordinary course of business, and you receive less than fair market value for what you gave away.
Ah, so the IRS is looking out for disguised gifts.
Exactly. They want to make sure transfers of wealth are treated appropriately. And a key thing to remember, all your reportable gifts for a single calendar year go on one Form 709 for that year.
One form per year. You can't mix years.
Correct. No mixing years. And you can't file, say, 2 forms for 2024 just because you made gifts at different times. One form covers the whole calendar year.
Okay, that makes sense. So this naturally leads to the big question. Who must file Form 709? Because you mentioned sometimes you file even if no tax is due.
That's a really important point. Filing isn't just about paying tax. It's often about reporting and utilizing exemptions correctly. So for U.S. citizens or residents, there are a few key triggers.
All right, let's break those down.
First, and this is the most common one, if you give gifts to any one person other than your U.S. citizen spouse that total more than the annual exclusion amount in a single year, you generally need to file. For 2024, that amount is $18,000.
$18,000 per person. So if I give $10,000 to my son and $10,000 to my daughter, I'm okay.
In that specific case, assuming those are the only gifts and their present interests, yes, you're under the $18,000 limit for each, so no filing required just for those. But if you gave your son $20,000, you'd need to file to report that gift, even though part of it is covered by the exclusion.
Got it. Over $18K to one person triggers filing. What's next?
Second, if you give gifts of future interests, regardless of the value, this is a big one.
Future interest. Okay, what does that mean exactly?
Think of it this way. A present interest gift is something the recipient can use, possess, or enjoy immediately, like handing someone cash. They have it right now. A future interest is where their right to use or enjoy the property is delayed until sometime in the future. Maybe it's a trust where they don't get income until they turn 30, or a remainder interest in property.
So if the enjoyment is pushed off.
Right. And because future interests don't qualify for that $18,000 annual exclusion, you must file Form 709 to report them, even if the value is tiny. Even a dollar gift of a future interest technically requires filing.
Wow, okay. That's strict. What else?
Third, and this is a huge tax-saving strategy we'll definitely dig into more, if you and your spouse elect to split gifts, if you choose to do this, you must file Form 709 no matter the gift amount.
Gift splitting. Okay, bookmark that. Sounds important.
It is. Fourth, If you make gifts of community property or property held as joint tenants with rights of survivorship or tenants by the entirety, where you and your spouse each own half, then each of you is considered to have made half the gift. So if the total gift exceeds double the annual exclusion or involves future interests, both spouses might need to file their own Form 709.
Okay, so joint property might require both spouses to file.
Potentially, yes. And one last point on who files. It's always individuals. If a trust, an estate, a partnership, or a corporation makes a gift, the IRS looks through the entity to the individual beneficiaries, partners, or stockholders. They are considered the donors.
So the entity itself doesn't file Form 709.
Correct. The individuals behind it do. And typically the donor is responsible for paying any gift tax. But if the donor doesn't pay, the recipient, the done, could actually be held liable for the tax.
Interesting. And if the donor passes away before filing?
Then their executor has the responsibility to file the final Form 709.
Okay, that covers who must file. Now, for the really exciting part, especially for listeners focused on smart financial moves, who doesn't need to file? And maybe even more importantly, what kinds of transfers just flat out aren't considered gifts for tax purposes at all?
Ah, yes. This is where some significant tax savings can be found. Because if something isn't technically a gift under the tax rules, you don't report it, and it doesn't use up any of your exclusions.
So totally off the Form 709 radar, what are these?
There are 4 crucial categories to understand. First, transfers to political organizations. If you give money or property to what's called a Section 527E1 political organization for its use, that's exempt. No gift tax, no Form 709 reporting needed for that.
Okay, political donations are out.
Second, similar idea, transfers to certain exempt organizations. This covers specific types like civic leagues under 501c4, labor or agricultural groups under 501c, or business leagues under 501c6, as long as they're tax exempt and the transfer is for the organization's use. Again, not a taxable gift.
Got it. Exempt orgs too. What's number 3?
Number 3 is a really big one for families, especially those planning for education costs. Payments that qualify for the educational exclusion.
Ah, tuition payments.
Exactly. But here's the critical detail. The gift tax does not apply to amounts you pay directly to a qualifying educational organization, could be domestic or foreign, specifically for tuition.
Directly to the school, only for tuition.
Precisely. The payment must go straight to the institution. Checks payable to the student, even if earmarked for tuition, don't count for this exclusion. And it must be for tuition only. It doesn't cover books, supplies, room and board, dorm fees, things like that. Those would be considered gifts to the student, potentially covered by the separate $18,000 annual exclusion.
Okay, so if grandma wants to pay her grandson's $50,000 college tuition bill.
If grandma writes that $50,000 check directly to the university, specifically for tuition, that entire $50,000 is not a gift for tax purposes.
Yeah.
It's completely outside the gift tax system, doesn't use her annual exclusion, doesn't use her lifetime exemption. It's an unlimited exclusion.
Wow, that's huge.
It really is. But another crucial distinction, contributions to a 529 plan, those qualified tuition programs, they do not qualify for this unlimited educational exclusion. They're treated differently under the gift tax rules, involving the annual exclusion, which we'll get to.
Okay, so direct tuition payment is special. What's the 4th category?
4th is the medical exclusion. It works very similarly to the educational one. The gift tax doesn't apply to amounts you pay directly to a person or institution that provided medical care for an individual.
Again, directly to the provider.
Directly to the doctor, the hospital, the healthcare provider, and the payment must be for medical care as defined in the Internal Revenue Code, Section 213, Title K. That generally covers expenses for diagnosis, cure, treatment, prevention of disease, things affecting body function, even transportation primarily for medical care. It also includes paying for medical insurance premiums for someone.
Okay, so paying Aunt Mary's hospital bill directly.
Likely qualifies for the medical exclusion? Yes. But there's a catch here. This exclusion does not apply if the medical expenses are reimbursed by the recipient's insurance.
Ah, so no double dipping.
Right. If Aunt Mary's insurance covers $10,000 of her $15,000 bill, and you pay the full $15,000 directly to the hospital, only $5,000 qualifies for the medical exclusion. The other $10,000, the reimbursed amount, is considered a gift from you to Aunt Mary.
Okay, that makes sense. Any others?
One more concept. Qualified disclaimers. This is when the intended recipient of the gift formally refuses to accept it. If they do it correctly, it has to be in writing, done within 9 months. They can't have accepted any benefit from it, and the property passes to someone else without their direction. Then it's treated as if the gift never went to them in the first place. The disclaiming person isn't considered to have made a gift to whoever ultimately gets the property.
So they can just say no thanks properly, and it avoids gift tax issues for them.
Essentially, yes. It's a way to redirect inheritances or gifts, sometimes for estate planning purposes. So why does all this matter? These educational and medical exclusions in particular are unlimited. They allow for potentially huge transfers of value completely outside the gift tax system. That's a massive tax-saving opportunity.
So just imagine this. You could pay like $100,000 in tuition directly to a university for your niece and pay $50,000 in medical bills directly to a hospital for your parent. And none of that counts against your $18,000 annual gift exclusion for them, and none of it uses your lifetime exemption.
Exactly right. It all comes down to structuring the payment correctly, directly to the institution or provider. That's the key takeaway.
That's a huge aha moment. Okay, let's shift gears slightly. We've talked about what's not a gift. Now let's talk about the bedrock of planning for things that are gifts. The annual exclusion. This seems like the first line of defense for most people.
It absolutely is. The annual exclusion is fundamental to gift tax planning. As we mentioned, for 2024, the first $18,000 of gifts of present interest you make to each done during the calendar year is subtracted from your total gifts when figuring out your taxable gifts.
And the emphasis there is on each done, right? It's not $18,000 total for everyone you give to.
Correct. It's per person. So you could give $18,000 to your son, $18,000 to your daughter, $18,000 to your nephew, $18,000 to a friend. That's 4 exclusions, totaling $72,000 in gifts, none of which would be taxable or require filing Form 709, provided they're all present interest gifts and you didn't make other reportable gifts.
Okay, but that present interest qualifier keeps coming up. Let's nail that down again.
Right. So a present interest gift means the recipient has the immediate unrestricted right to use, possess, and enjoy the property or the income from it. Think cash, a car they can drive immediately, stocks they control now.
Immediate access.
Yes. A future interest, on the other hand, delays that right. Their use, possession, or enjoyment starts at some point in the future. Common examples are remainder interests in property, like you get the house after mom passes away, or contributions to certain types of trust where beneficiaries don't have immediate access to the funds or income.
And the punchline is,
Gifts of future interest do not qualify for the $18,000 annual exclusion. 0 exclusion applies. That's why you must file Form 709 to report any gift of a future interest, even if it's just a small amount, because it's automatically a potentially taxable gift from $1.
okay, crystal clear. Present interest gets the exclusion, future interest doesn't, and requires filing. What about gifts to kids, minors? Can those be present interests?
Yes, they can, but there are specific rules to make sure a gift to a minor qualifies as a present interest for the annual exclusion. 3 conditions have to be met.
All right, what are they?
1. Both the property itself and any income it generates must be available to be spent by or for the benefit of the minor before they turn 21.
Okay, usable before 21.
2. Any remaining property and accumulated income must pass directly to the minor when they turn 21.
They get it all at 21.
And 3. If the minor happens to die before reaching 21, the property and income must be payable either to the minor's estate or to whomever the minor might appoint under something called a general power of appointment.
Okay, covers premature death if all 3 are met.
Then the gift to the minor qualifies as a present interest, and you can use the $18,000 annual exclusion against it. This is often achieved through specific types of trusts, like a Section 2503C trust or using a Uniform Transfers to Minors Act, UTMA account.
Got it. Now, you mentioned spouses earlier. What about gifts to a spouse who isn't a U.S. citizen? Is the $18,000 limit different there?
Ah, yes, very different and quite fascinating. While gifts to a U.S. citizen spouse are generally unlimited and tax-free thanks to the marital deduction, we'll get to that, the rules are different for non-U.S. citizen spouses. For 2024, the annual exclusion for gifts to a non-U.S. citizen spouse is much higher. It's $185,000.
Whoa, $185,000. That's a big jump from $18,000.
It is, but there's a condition. That extra amount, the $167,000 above the standard $18,000, only qualifies for this special exclusion if the gift would otherwise have qualified for the regular gift tax marital deduction if the spouse had been a U.S. citizen. Basically, it needs to be the type of gift that would normally be deductible between citizen spouses.
Okay, so it's a higher limit, but with a string attached regarding the type of gift.
Exactly. And if your total gifts to your non-U.S. citizen spouse in 2024 exceed that $185,000 threshold, or if any portion of the gifts are future interests, then you must report all the gifts on Form 709. Even if a deduction might apply to some part of it, the filing is triggered.
That's a critical distinction. 185K annual exclusion for non-citizen spouses, but exceeding it means filing.
Okay.
So we've got the annual exclusion, which is powerful. But you hinted earlier about a way to sort of supercharge it, especially for education planning using 529 plans. This sounds like a favorite strategy.
It really is a game changer for people wanting to front-load college savings. It relates to contributions to qualified tuition programs or 529 plans. Here's the deal. If you contribute more than the annual exclusion amount, again, $18,000 in 2024, to a 529 plan for a single beneficiary in 1 year, you can make a special election.
An election, what does it let you do?
It lets you treat a contribution of up to 5 times the annual exclusion amount, so up to $90,000 in 2024, as if you made it evenly or ratably over a 5-year period.
So you can give a big chunk now, but spread the gift tax impact over 5 years.
Precisely. You're essentially using 5 years' worth of your annual exclusions for that one beneficiary, all in the year you make the contribution.
Could walk me through an example. Let's say I want to dump $100,000 into my grandchild's 529 plan this year.
Okay, $100,000 in 2024. The maximum you can elect to spread over 5 years is $90,000, 5 times $18,000. So first, you have the amount over the election limit, which is $10,000, 100K minus 90K. That $10,000 is a gift in 2024.
Right, the excess above the 90K.
Then you take the $90,000 you're electing to spread, and you treat 1/5 of it, $18,000, as a gift in 2024. So on your 2024 Form 709 Schedule A, Part 1, you'd report a total gift to your grandchild of $28,000, the $10,000 excess plus the $18,000 first-year portion of the election.
Okay, $28,000 reported for 2024. What about the next 4 years?
For each of the next 4 years, 2025 through 2028, you'll be treated as having made an $18,000 gift to that grandchild, representing the remaining 4/5 of the $90,000 election. Now, here's a nuance. If you don't make any other gifts to that grandchild in, say, 2025, that would require you to file Form 709 anyway, you actually don't need to file a return just to report that $18,000 slice of the 5-year election. It only potentially requires filing if your other gifts in that year push you over the line.
Ah, okay. So the election itself doesn't force filing in future years unless other gifts are made.
Correct. The huge benefit here is moving a large sum up to $90,000 per donor per beneficiary into the 529 potentially out of your taxable estate much sooner while still leveraging the annual exclusion over 5 years. It's great for accelerating education funding.
And just to be clear, this is not the same as the unlimited educational exclusion for direct tuition payments.
Absolutely not. That direct tuition exclusion is totally separate and unlimited. This 529 strategy is specifically about using the annual gift exclusion, just spreading a larger contribution over 5 years' worth of those exclusions. You make this election by checking a box on line B at the top of Schedule A on Form 709 and attaching an explanation.
Got it. So understanding present interest and using tools like this 529 election really lets you maximize those annual exclusions. Very powerful. Now let's talk about teamwork. How can spouses really work together to maximize their gift-giving power? It feels like marriage offers some unique advantages here.
It absolutely does. Looking at the bigger picture, probably one of the most powerful tax-saving strategies available to married couples making gifts to third parties like children or grandchildren is gift splitting.
Gift splitting. We bookmarked that earlier. Let's unpack it.
Okay, so married couples cannot file a joint gift tax return. Each spouse has to file their own Form 709 if they're required to file. However, they can elect to split gifts. If both spouses consent, all gifts made by either spouse to third parties during that calendar year are treated as if they were made 1/2 by each spouse.
1/2 by each. What's the big deal there?
The aha moment is huge. It effectively doubles the annual exclusion for each recipient. Think about it. Instead of one parent giving $18,000 tax-free to their child.
But by splitting the gift, the couple can give $36,000 to that same child, completely free of gift tax and without using any lifetime exemption.
Exactly. $18,000 is considered given by mom, $18,000 by dad, even if only one of them actually wrote the check. It's an incredibly efficient way to transfer wealth. If they want to help their daughter with a $36,000 down payment, gift splitting makes it entirely tax-free under the annual exclusions.
That's fantastic. Are there conditions?
Yes, a few important ones. You both have to be U.S. citizens or residents. You have to be married to each other at the time the gift is made.
Yeah.
If you get divorced or one spouse dies later in the year, neither of you can have remarried during the rest of that calendar year for the splitting election to apply to gifts made while married.
Okay. Married at the time of gift, no remarriage in the same year if divorced, widowed.
Also, you can't give your spouse what's called a general power of appointment over the property you're gifting to the third party. and a really important consequence to understand. If you effectively consent to split gifts, you each become jointly and severally liable for the entire gift tax liability of both spouses for that year.
Meaning, if my spouse doesn't pay their share of the tax, the IRS could come after me for the whole amount.
That's what joint and several liability means, yes. Now, generally, if you split gifts, both spouses have to file a Form 709, but there are a couple of specific exceptions where only one spouse might need to file.
Oh,
For example, if only one spouse actually made gifts during the year, and the total value of those gifts to each individual third-party recipient wasn't more than $36,000, and all the gifts were present interests. In that case, only the spouse who actually made the gifts needs to file, but the other spouse still has to consent on that return.
okay. Simplifies filing a bit in some cases. How do you make the consent official?
The consenting spouse, the one who didn't necessarily write the checks but agrees to split, must sign and date a specific notice of consent statement. It declares they agree to split all gifts made by either spouse during the year. This signed statement must be attached to the Form 709 filed by the donating spouse, or both returns if both are filing. It's not enough just to check the box on the form. The signed consent is key.
Attach the signed consent. Got it. That doubling effect is really compelling. Now, what about gifts between the spouses themselves? Are those treated differently?
Oh yes, very differently, especially if both spouses are U.S. citizens. This involves the marital deduction, another cornerstone of tax saving. Generally speaking, gifts made between spouses who are both U.S. citizens are unlimited and completely tax-free.
Unlimited, regardless of amount.
Regardless of amount, and it doesn't matter if it's a present interest or a future interest. For the most part, you don't even need to file Form 709 to report gifts to your U.S. citizen spouse. This allows couples to freely transfer assets between themselves without worrying about gift tax.
That seems straightforward. Are there exceptions?
The main exception involves gifts of terminable interests. This is where the interest you give your spouse could end or fail after some time or event, and someone else might get an interest in the property after your spouse's interest ends. Think of giving your spouse the right to income from a property for 10 years, with the property then going to your child. That income interest is terminable.
And those are generally not deductible.
Generally, gifts of terminable interests are non-deductible under the marital deduction rules, and you'd likely have to report them on Schedule A. However, there are exceptions to the exception.
Of course there are. Like what?
One major one is a life estate with the general power of appointment. If you give your spouse an interest where they get all the income from the property for life, paid at least annually, and they have the unrestricted power to decide who gets the property, either while alive or in their will, and no one else can appoint the property to anyone but your spouse, then that gift does qualify for the marital deduction, even though it's technically a life estate. No special election needed.
Okay, so full income rights plus full control over who gets it eventually makes it deductible.
Right. But there's another powerful tool if the spouse doesn't have that ultimate control: the Qualified Terminable Interest Property, or QTIP election.
QTIP. Heard that term before.
With a QTIP election, you can choose to make a gift of a terminable interest deductible, even if your spouse doesn't have the power to say who gets the property after their interest ends. The key requirements are that your spouse must still get all the income for life, paid at least annually, and no one can appoint the property to anyone else during your spouse's lifetime.
So they get the lifetime income, but maybe you decide who gets the property after they pass away.
Exactly. That's a common use case. You make the QTIP election simply by listing the property on Schedule A of Form 709 and then deducting its value on Schedule A, Part 4, Line 4. If you list it and deduct it, the IRS presumes you've made the election. But be warned, once you make a QTIP election, it's irrevocable. You can't change your mind later.
Irrevocable. Okay. QTIP offers control plus the deduction. And just to circle back quickly on non-U.S. citizen spouses.
Right. As we said, the annual exclusion is $180,000 for 2024. But if you give more than that, or give future interest, you must file Form 709, even if some part of the gift might qualify for a marital deduction under specific rules for non-citizen spouses, often involving qualified domestic trusts or QDOTs, which is a more complex topic. So filing is triggered much more easily than with a U.S. citizen spouse.
Okay, that distinction is super clear now. Thanks. All right, we've covered the core concepts, the strategies. Let's actually get into the form itself. When you sit down with Form 709, what are the key sections donors absolutely need to nail, and how does filling them out right connect back to these strategies.
Absolutely. Let's walk through the main sections. Paying attention here isn't just about avoiding mistakes. It's about making sure you're claiming the deductions and exclusions correctly. We'll start with Part I general information on page 1. This is the basic stuff: your name, address, social security number, or ITIN. They've added specific fields now if you have a foreign address. You also indicate your legal residence, domicile, and citizenship here. Pretty straightforward, but accuracy is key.
Okay, basic ID info. What else is in Part 1?
Line 19 is really important. That's the checkbox where you indicate yes or no to electing gift splitting with your spouse. Checking yes. Here's the first step, and it points you toward completing Part 3 later.
Right, the trigger for gift splitting consent.
Also on line 19, there are checkboxes related to applying any deceased spousal unused exclusion DSUE amount you might have inherited from a predeceased spouse. This connects to Schedule C, which handles portability.
DSUE. Okay, we'll get to that. What else is new or notable here?
Line 21, digital assets. This is new for 2024 returns. It asks point blank, at any time during 2024, do you transfer any digital asset or a financial interest in a digital asset reported on this return?
Digital assets, like crypto, NFTs.
Exactly. The instructions define it broadly. NFTs, virtual currencies like Bitcoin or Ethereum, stablecoins, anything recorded on a cryptographically secured distributed ledger. The really crucial point here is you must check either yes or no. You cannot leave it blank. Even if you had 0 digital asset transfers, you check no.
So the IRS wants a definitive answer from everyone on digital assets now.
Seems that way. It shows their increasing focus on tracking these types of assets for gift and estate tax purposes. Okay, then there's Part 3, spouse's consent on gifts to third parties.
Which you only fill out if you checked yes to gift splitting on line 19, right?
Correct. This section confirms you were married during the relevant period, asks about divorce or widowhood during the year. It also repeats the advice that filing both spouses' returns together can help processing if you are splitting gifts.
But the most critical part here is
The notice of consent. As we discussed, just checking the box isn't enough. Your spouse, the one consenting to split the gifts, must sign a separate statement agreeing to split all gifts made to third parties during the year. That dated, signed statement absolutely must be attached to the return. Without it, the gift-splitting election isn't valid, and you could lose that doubled annual exclusion benefit.
okay, attach the signed consent, don't forget that. So after the general info and consent, we get to Schedule A, where the gifts are actually listed. This feels like the core of the return. What are the pitfalls or strategic points here?
Schedule A is absolutely the heart of it. This is where you detail every single reportable gift. The schedule itself is divided into 3 parts to help categorize things. Part 1 is for gifts subject only to gift tax. Think gifts to your kids, friends, non-skip persons, or even charities, though those get deducted later. Part 2 is for gifts subject to both gift tax and the generation skipping transfer, GST tax, right away. These are called direct skips, typically gifts directly to grandchildren or great-grandchildren or certain trusts for their benefit. And Part 3 is for gifts subject to gift tax now, but where the GST tax might apply later. These are often indirect skips, like gifts to trusts that might eventually benefit skip persons down the line.
Okay, 3 categories based on who gets the gift and when GST tax might hit. What about the top of Schedule A?
2 important lines right at the top. First, line A asks about valuation discounts. This is a huge strategic area. If the value you're reporting for any gift includes a discount maybe for lack of marketability on private stock, a minority interest discount, a fractional interest in real estate, you must check yes.
And if you check yes,
You must attach a detailed explanation. It needs to show the basis for the discount claimed and the actual amount of the discount. Getting this right often requires a professional appraisal, but it can significantly reduce the taxable value of the gift. It's a major tax reduction lever.
So valuation discounts need backup documentation. What's line B?
Line B is for qualified tuition programs, 529 plans. This is where you check the box if you're making that 5-year election we talked about for contributions over the annual exclusion. You check it here, attach your explanation, and then report the appropriate first-year amount down in Part 1 of the schedule.
Got it. Now the columns where you list the gifts, looks like they want a lot of detail.
They want precision. Columns B through D are for the description of the gift, donee's name and address, and donor's relationship to donee. The description needs to be specific.
Like how specific?
Very specific. For real estate, legal description, street address, details about improvements. For bonds, number of bonds, principal amount, obligor name, maturity date, interest rate, CUC number if available. For stocks, number of shares, common or preferred, par value, exact corporation name and location, CUC number. For life insurance, the insurer's name and the policy number, and you'll usually need to attach Form 712 from the insurance company.
Wow, okay. No room for vague descriptions.
None. For closely held entities, they want the employer identification number, EIN. If the gift involves an interest based on someone's life, you need their date of birth. And crucially, if the gift creates what's called an estate tax inclusion period, ETIP, meaning the property might still be included in your estate for a time, you must clearly identify that in the description.
E-tip, another one to remember. Okay, what about the other columns?
Column E is for the donor's adjusted basis. This is generally what you paid for the asset, plus improvements minus depreciation, if applicable. It's the basis you'd use for income tax if you sold it.
Okay, your cost basis.
Yeah.
Then F and G.
Column F is the date of gift, and column G is the value of the gift on that date. This value must be the fair market value, FMV.
Fair market value. How is that determined?
The standard definition is the price a willing buyer would pay a willing seller, with both having reasonable knowledge of the facts and neither being forced to act. For publicly traded stocks and bonds, it's usually based on the average of the high and low selling prices on the gift date. But for things like closely held business stock or real estate, that's much harder.
Yeah, how do you value stock in a private family company?
That requires looking at things like the company's net worth, earning potential, dividend-paying capacity, the value of similar publicly traded companies. It almost always requires a qualified appraisal. Same for unique assets like art or real estate. There are also special complex valuation rules under Sections 2701 and 2702 that apply to certain transfers of interests in family-controlled entities or trusts where the donor keeps an interest. These are designed to prevent artificially low valuations in family transfers. Getting the FMV right and documenting how you got it is absolutely critical.
Understood. Professional valuation is key for non-public assets. What's the last column H?
Column H is net value. This is where you'd enter your half of the gift's value only if you elected gift splitting with your spouse on line 19. If you didn't split gifts, this column usually matches column G.
Okay. Only used if splitting. And what about documentation?
Supplemental documents are essential. The instructions are very clear. You must attach information supporting the values you claim. Appraisals for real estate or hard-to-value assets, financial statements for closely held businesses, Form 712 for life insurance, copies of trust documents for gifts and trust. If you don't attach the required documents, Schedule A needs a full explanation of how you determine the value. Fail to do this, and you risk the IRS questioning your valuation later.
That's a recurring theme detail, documentation, precision. It really highlights the need for good records, maybe even professional help. Okay, we've covered the gifts made this year on Schedule A, but Form 709 isn't just a snapshot of the present, is it? It seems to look backward and forward too, tying into your overall lifetime giving and estate planning. How does that work?
Exactly right. This form is cumulative in nature. It tracks your gift-giving history to determine your remaining lifetime exemption. This happens primarily on Schedules B and C. Let's start with Schedule B gifts from prior periods.
Okay, what's the purpose here?
Schedule B is where you list all the taxable gifts you've made in previous years or quarters, depending on the filing rules at the time. This is crucial because the gift tax system integrates your lifetime giving. Your current year's taxable gifts get added to all your prior taxable gifts.
To get a cumulative total?
Precisely. This cumulative total is then used to figure out where you stand in terms of using up your lifetime applicable exclusion amount, that big exemption that shields gifts and estates from tax, which is $13.61 million per person in 2024. Schedule B helps calculate how much of that exclusion you've already used through prior gifts.
So you list the year where you filed the return.
Hey.
What else?
You also need to report the amount of taxable gifts for each prior period, and importantly, the amount of the applicable credit, or unified credit as it used to be called, that was used against those gifts. There's a specific worksheet mentioned in the instructions, the worksheet for Schedule B, column C, that you might need to use.
A worksheet. When is that needed?
It's generally used if your prior taxable gifts exceed certain thresholds, like $500,000. Because the credit amounts and tax rates have changed dramatically over the years, this worksheet helps ensure you're correctly calculating how much credit was effectively used based on today's rules, even for very old gifts.
So it recalculates the past credit usage based on current law.
In a way, yes. It standardizes the calculation.
Yeah.
The key takeaway for Schedule B is Even if you didn't actually pay gift tax in prior years because the credit covered it, you still must report all those prior taxable gifts here. It's about tracking the use of your lifetime exclusion.
Okay, so Schedule B is the look back. Now, you mentioned Schedule C. This deals with portability and that restored exclusion amount. These sound like game changers.
They really can be, particularly portability. Schedule C is titled Portability of Deceased Spousal Unused Exclusion, DSUE amount, and Restored Exclusion amount. Let's tackle DSUE first.
Portability. This is huge for surviving spouses, right?
Yeah. Absolutely huge. For people who died after 2010, the executor of their estate can make an election on the estate tax return, Form 706, to transfer any unused portion of the deceased spouse's estate and gift tax exclusion amount to the surviving spouse.
So if the first spouse to die didn't use all their $13.61 million exemption,
The leftover amount, the DSUE amount, can be added to the surviving spouse's own exemption. The surviving spouse can then use this combined amount against their own lifetime gifts reported on Form 709 or against their estate tax when they pass away.
so potentially a surviving spouse could have an exemption of over $27 million, 13.61 men are owned plus 13.61 million DSUE.
Theoretically, yes, if the first spouse used none of their exemption and the executor made the portability election. It effectively allows married couples to fully utilize both spouses' exemptions. You report the DSUE amount available and the amount you're applying to current gifts on Schedule C.
That's incredibly valuable. Are there catches?
A key one is the last deceased spouse rule. The DSUE amount you can use is always from your most recently deceased spouse from who you inherited DSUE. If you remarry and your new spouse dies, any DSUE from the first spouse is lost if you inherit DSUE from the second spouse. You can't stack DSUE amounts from multiple predeceased spouses.
Okay, it's only from the last one.
Right. And the IRS reserves the right to examine the first spouse's estate tax return to verify the DSUE amount, even if the statute of limitations for assessing tax on that return is passed.
Got it. Now, what about the other part of Schedule C, the restored exclusion amount? That sounded specific.
It is very specific, and it stems directly from the Supreme Court's 2013 decision in United States v. Windsor, which struck down key parts of the Defense of Marriage Act.
DOMA. Okay, how did DOMA affect gift taxes?
Before Windsor, DOMA meant the federal government didn't recognize same-sex marriages. For gift tax, this meant that gifts between same-sex spouses did not qualify for the unlimited marital deduction that opposite-sex couples enjoyed. So if one same-sex spouse gave a large gift to the other, they often had to use up part of their lifetime applicable exclusion amount to avoid paying tax, whereas the opposite-sex couple wouldn't have had to.
So they were forced to use their exemption where others wouldn't.
Exactly. After Windsor mandated federal recognition, this provision for a restored exclusion amount was created. It allows taxpayers who made those now retrospectively deductible gifts to their same-sex spouse before the Windsor ruling to essentially recalculate and get back, or restore, the applicable exclusion amount they were previously forced to use on those gifts.
So they can add that previously used exclusion back to their available lifetime amount.
Yes, there's a specific calculation based on the ratio of those gifts to the spouse versus total taxable gifts made. The resulting restored exclusion amount is entered on Schedule C, line 3, and increases the total exclusion available for current and future gifts or estate tax. It was a way to retroactively correct the inequality caused by DOMA for gift tax purposes.
That's a fascinating piece of tax history reflected right there on the form, a real aha moment for those affected. Okay, Schedules B and C handle the past and portability. But you also mentioned the generation skipping transfer GST tax earlier. That sounds like planning for the really distant future, like grandchildren or beyond. Where does that fit in?
That brings us to Schedule D computation of GST tax. This is definitely about advanced multi-generational legacy planning.
What's its main job?
Schedule D does two main things. First, it's used to calculate and report the GST tax due on any direct skips made during the year. Remember, those are gifts directly to skip persons, like grandchildren. Second, and perhaps more importantly for planning, it's where you allocate your lifetime GST exemption.
There's a separate GST exemption.
Yes, and it's currently the same amount as the gift state tax exclusion, $13,610,000 for 2024. But it's a separate exemption specifically for GST tax purposes. You can use your gift state tax exclusion and your GST exemption independently.
Okay, $13.6 million just for GST. Let's revisit those definitions. Direct skip and skip person.
Sure. A skip person is generally someone 2 or more generations younger than the donor, like a grandchild or great-grandchild. It could also be certain types of trusts where all the beneficiaries are skip persons. A non-skip person is anyone else, like your child. A direct skip is a transfer directly to a skip person that is also subject to gift or estate tax.
So giving $100,000 cash directly to my grandchild.
That's a classic direct skip. It's subject to gift tax, though offset by your annual exclusion and lifetime exemption, and it's also potentially subject to GST tax. You'd report it on Schedule A, Part 2, and deal with the GST implications on Schedule D.
What about a trust for my grandchild?
Depends on the trust terms. If the trust can only benefit the grandchild, and maybe other skip persons, then the gift to the trust is likely a direct skip. But if, say, you create a trust for your child for life, with the remainder going to your grandchild, the initial gift to the trust is not a direct skip, because the child, a non-skip person, has an interest. GST tax might apply later when the trust terminates or makes distributions to the grandchild. That's an indirect skip scenario.
Okay, direct skips hit GST tax now, indirect skips potentially later. What about that ETIP thing you mentioned, estate tax inclusion period?
Right. ETIPs complicate GST timing. If you transfer property but retain an interest such that the property might be included back in your estate if you died during a certain period, like with some trusts, such as a GRAD or QPRT, then the allocation of GST exemption and the potential GST tax itself are deferred until that inclusion period ends, the ETIP closes. You report the gift tax part now, but the GST part waits.
So the GST calculation is delayed until the estate tax risk passes.
Essentially, yes. Now, the most crucial part of Schedule D for planning is the strategic allocation of GST exemption. This is where you decide how to use that $13.6 million GST shield.
How does that work? Is it automatic?
Sometimes it is, sometimes it isn't, and you have choices. For direct skips made during your lifetime, the law automatically allocates enough of your unused GST exemption to make the inclusion ratio 0, meaning no GST taxes due, unless you specifically elect out of the automatic allocation.
Why would you elect out of automatically shielding the gift?
It's a strategic choice. Maybe you think that direct skip gift is small, and you'd rather save your precious GST exemption to shield a much larger transfer later, perhaps an indirect skip to a long-term dynasty trust. You elect out by filing Form 709, even if not otherwise required just for gift tax, and attaching a statement saying you don't want automatic allocation for that specific transfer.
So you can preserve the exemption for bigger fish later. What about indirect skips, gifts to trusts that aren't direct skips?
For gifts to GST trusts that could potentially have a generation-skipping transfer in the future, the allocation rules are also automatic unless you elect otherwise. You can elect out of automatic allocation for the current gift, or even for all future gifts to that specific trust. Conversely, you can elect into treating a trust as a GST trust to ensure automatic allocation applies if it otherwise wouldn't. There's also a special election related to QTIP trusts, allowing you to treat it differently for GST purposes than for gift estate tax, the reverse QTIP election, which helps optimize exemption use.
Wow, lots of elections and strategic decisions around GST exemption. Why is managing it so important?
Because if you don't allocate your GST exemption effectively, either automatically or by election, and a generation-skipping transfer occurs later, like a trust distributing to a grandchild, that transfer could be hit with GST tax at the highest federal estate tax rate, which is currently 40%. Properly allocating your exemption ensures that potentially vast amounts of wealth can pass down multiple generations completely free of this additional layer of tax. It's fundamental to long-term legacy planning.
40% tax is definitely something you want to plan around. Okay, that covers the advanced planning schedules. We've been through a lot. We've journeyed from the basics of who needs to file Form 709 all the way to sophisticated strategies involving portability and generation-skipping trusts. Now, let's bring it all home. How do you actually finalize this return, calculate the tax, get it filed, and what are the last crucial things to remember to avoid, headaches down the line?
Right. The final steps are all about pulling it together accurately and ensuring compliance. Let's start with Part 2, tax computation, which is back on page 1 of the form.
Okay, this is where the numbers come together.
Exactly. This is the culmination. It takes the total taxable gifts calculated from Schedule A, considers prior taxable gifts from Schedule B, applies deductions like the marital deduction from Schedule A, Part 4, Line 4, and the charitable deduction, Schedule A, Part 4, Line 7, calculates the tentative tax, and then applies your available applicable credit, including any DSUE from Schedule C, and considering prior credit used from Schedule B to arrive at the actual gift tax due, if any.
So all those schedules feed into this final calculation.
Precisely. Accuracy on the schedules is paramount for an accurate Part 2 computation. Next up, when to file.
We touched on this, but let's recap.
Form 709 is an annual return. Generally, it's due on April 15th of the year following the year you made the gifts. So for 2024 gifts, the deadline is April 15th, 2025. If that date falls on a weekend or holiday, it shifts to the next business day.
And extensions.
An extension to file your federal income tax return, Form 1040, using Form 486E, automatically extends the time to file your Form 709 as well, usually until October 15th. If you don't need an income tax extension but do need one for Form 709, you file Form 8892 by April 15th for an automatic 6-month gift tax filing extension.
But the critical point about extensions is,
An extension to file is not an extension to pay. If you estimate you'll owe gift tax, that payment is still due by the original April 15th deadline, even if you have an extension to file the return itself. Pay late, and you'll likely face interest and penalties.
got it. File later, maybe, but pay on time. What if the donor dies?
If the donor dies during the year they made gifts, their executor must file the final Form 709. The due date is the earlier of the regular due date, April 15th of the following year, or the due date, including extensions, for filing the donor's estate tax return, Form 706.
Okay. Where to file? Does it go to the same place as income tax returns?
Usually not. For standard mail, Form 709 generally goes to the IRS Center in Kansas City, Missouri. There's a specific address for that and a slightly different street address if you're using a private delivery service like FedEx or UPS. The instructions have the exact addresses.
Kansas City. Good to know. What if you make a mistake? Can you fix it?
Yes, you can file an amended Form 709. If you need to correct errors or add supplemental information after you've already filed, you just prepare a new Form 709 for the same year. You check the amended return box, it's line 15 in Part 1, fill it out correctly, and attach a statement explaining exactly what changed from the original return and why. It's usually helpful to attach a copy of the original return as well. Amended returns typically go to a different IRS address, usually in Florence, Kentucky.
Okay, amended returns are possible. Now, you mentioned documentation before, but there's this concept of adequate disclosure. Why is that so vital?
Adequate disclosure is absolutely critical because it's what starts the clock running on the statute of limitations for the IRS to challenge your gift. Generally, the IRS has 3 years from the date you file the return to assess additional gift tax.
But if the gift isn't adequately disclosed...
If a gift is not adequately disclosed on Form 709 or an attached statement that meets the requirements, the statute of limitations for that specific gift may never begin to run. That means the IRS could come back, potentially years, even decades later, and challenge the valuation or tax treatment of that gift.
Wow. So what constitutes adequate disclosure?
It requires more than just listing the gift. You need a complete Form 709, a detailed description of the property, any consideration received, the identity and relationship of everyone involved, trust details, EIN, description or copy of the instrument, if applicable, and critically, either a qualified appraisal meeting specific standards or a detailed description of the method used to determine fair market value, explaining the basis for any discounts claimed. Meeting this standard essentially protects you from indefinite IRS scrutiny on that gift.
So dot your I's, cross your T's, and provide the backup, especially on valuation.
Absolutely, it's your shield. Finally, let's briefly mention penalties.
The scary part.
Well, important to be aware of. There are penalties for filing late and for paying late, unless you can show reasonable cause. There are more severe penalties for willful failure to file or attempting to evade tax, and there are substantial penalties specifically for valuation understatements. If the value you report is found to be 65% or less of the correct value, that's a substantial understatement penalty. If it's 40% or less, it's a gross understatement with even higher penalties.
So getting the value wrong can be very costly.
Very. Tax return preparers can also face penalties for taking unreasonable positions or engaging in willful or reckless conduct. It all just reinforces the need for careful preparation, good record keeping, professional advice when needed, and robust valuation support, especially for complex assets.
So to kind of wrap this all up, Form 709, yeah, it looks complex, maybe even a bit daunting, but listening to you break it down, it feels less like just a compliance burden and more like, well, like a roadmap for sophisticated financial planning and strategic giving.
That's a great way to put it. Understanding these rules, particularly the exclusions, the deductions, the elections like gift splitting or the 5-year QTK rule, the portability rules, how to use the GST exemption. It's not just about checking boxes correctly. It's about actively using the tax code to be a more effective and strategic giver.
Our deep dive today into Form 709 really shows that navigating gift tax isn't simply about paying what might be due. It's much more about strategically using every tool available. The annual exclusion, direct payments for education and medical, gift splitting, DSUE, GST exemption to make sure your generosity is as tax efficient as it can possibly be.
Making your gifts work smarter, essentially.
Exactly. So here's a final, maybe provocative thought for you to mull over. How might proactively planning your significant gifts, really understanding forms like this, and consciously leveraging every single tax saving tool we've discussed, how might that fundamentally reshape not just your tax bill, but your entire financial legacy and the impact you can truly have on the people and causes you care about, not just now, but for generations down the line?
It shifts the perspective from reactive tax filing to proactive legacy building.
Precisely. It's not just about what you give, but how intelligently and strategically you give it. Now remember, this deep dive provides a solid foundation, but everyone's situation is unique. We strongly encourage you to consider consulting with a qualified tax professional or estate planning attorney to apply these insights specifically to your circumstances.
Definitely wise advice for navigating these complexities.
We really hope this deep dive empowers you to give more and to give more wisely.